Well, welcome all of you to this webinar. This webinar that it's something new that we've tried the last couple months, and we've found that it is it's been very beneficial for the prospective buyers that we're working with, and so today. This is about buying a business, and so I've got a number of my colleagues on that are going to discuss their opportunities and how we might be able to come alongside you to get you into business ownership. And I want to thank Live Oak Bank and John Randall for sponsoring today's webinar. We'll circle back to John a little bit in a little bit to talk about Live Oak and how SBA financing, which is just truly remarkable right now in the marketplace, and the access to capital is really robust. And so if you're ever thinking about buying a business, boy, now's the time. So a couple things, let me get to my slide deck. My name's Ed Meisegland, by the way. I'm the managing partner of Indiana Business Advisors. Indiana Business Advisors is a 40-year-old business brokerage. We've been helping buyers and sellers for, like I said, 40 years. We have about over 2,100 deals successfully completed. We've got locations in Lafayette, Fort Wayne, South Bend, and obviously Indianapolis. So again, some housekeeping and how this is going to work. Like I said, my colleagues are going to talk about the opportunities that they have. And if you have questions, over to your right-hand side or wherever your dashboard is, you can see a chat box, and just put your questions in if you have them, or as we go along. If not, and your fingers aren't that fast, don't sweat that either. Just email us, and we'll be more than happy to answer them after the webinar. So how do you get more information? Again, you can email us, you can put it in the chat, or you can certainly call the office also at 317-573-2100. We'll be more than happy to get that to you. Okay, if you have to leave, we will be recording this, so that's no big deal either. You'll be receiving a recording, and in addition to the recording, there's a couple handouts. We have this slide deck, so no big deal. You can reference it, and then our current list of companies that we have available for acquisition, and in its entirety, or I should say in its entirety, the ones that are currently active, not in process, getting prepared for marketing. Okay, so why don't we go ahead and get to this? Let me start with Jamar. Jamar, welcome to today's available for acquisition webinar. I wanted to talk to you first about this ice cream business. Can you brief us just a little bit about it, and then I've got some questions for you.
Yeah, sure thing. So they call me the ice cream man because I have a handful of these ice cream businesses available for sale. And this one is in central Indiana, and the great thing, as you can see here from the revenue and then the SDE, this is really an opportunity to come in and get a great return on an initial investment from that $145,000 asking price. And I'll tell you what, this as well is that it's such an established presence in central Indiana. And with that established presence, plus it's a franchise, there's some opportunity to have some already built-in systems. Marketing's already done, so we don't have to reinvent the wheel here. This is really a turnkey operation. The other thing I'll mention is that this location is absentee run. So the great thing here, after going through some training and transition, a new owner will be able to get some ROI turned pretty quickly within 12 to 18 months if revenue continues as it has. The other thing that we've seen within the short order food or the ice cream industry, and I see this across all of my clients who have similar businesses, they took a small dip in the spring with the quarantines and some of the closures, maybe 10, 12%. but people are still going out, they're getting ice cream, they're doing quick carry out, unlike some of the sit-down restaurants that really were affected. So an opportunity to grow this business is through concessions and festivals. Some ice cream vendors are seeing anywhere from $2,000 to $4,000 a day in revenue. So if an owner operator really wanted to get in and grow this, that's the primary way to do it and pick up a few $1,000s of additional revenue per month.
All right. One of the questions that came up, and I'll briefly describe it. We have an acronym called SDE, and that SDE stands for Seller's Discretionary Earnings. And basically, the formula for it is we add to the profit any non-cash expenses, so depreciation and amortization, any interest, because you, as a buyer, you're going to not have the same debt that the seller has. So we add all of that interest back. Then we add direct officers' compensation, as well as any direct or non-recurring expenses that might occur over the period we're examining. So that when you add all of that together, so again, we add to the profit all non-cash expenses, direct and indirect compensation, we get what's called seller's discretionary earnings. And that will serve as a gross amount for you to pay yourself, pay or a manager, pay your debt, and get a return of and on your investment. So Jamar, a couple questions that I wanted to ask you. That, has it always been an absentee-owned business?
Within the most recent years, yes. I mean, this business has a 50-year market presence, so not necessarily all 50 years, but sure. The current owner has been absentee over the last handful of years, yes.
Well, everybody wants to know why they would be retiring or are they retiring? Why they would be getting out if it's run absentee? Why now?
Yeah, and really it is retirement, just as you alluded to there. And really, this is a good time for the current owner to divest some of his assets and cash out.
I got it. Well, I'll tell you, after all of the podcast episodes that I've done, one of the primary things that everybody says is the most valuable thing in a business is being able to work yourself out of a job. And so an absentee-owned business is truly makes it a great opportunity. Okay, let's move on to our next one. Jeff Aaron. So Jeff, tell us about this digital advertising agency.
Yeah, so the owner is really an industry pioneer in this area of digital advertising. It's a sign content management company, and so think about promotional signs, some menu boards, messaging at a point of sale at a location where that message can change with specials, change in pricing, seasonal type messages. And there's really one of the advantages of the business is there's an extensive proprietary digital library of over 1,700 video and other image files that really is a business within a business. So sign companies are often calling the business asking to help manage the delivery of content for the sign manufacturing company. I think there's really a lot of growth opportunity within both that vertical within the company as well as geographically. The business is not geographically bound, so there are name brand companies throughout the U.S. and really throughout the world who are customers today, as well as because the service, the content delivery method is remote. The signs can be reprogrammed remotely, so you can literally serve your business anywhere in the world, which also makes the company relocatable. So it happens to be based in the Midwest today, but there's no reason that it couldn't be tucked into an existing business or relocated to the buyer's locale.
So one of the questions that I wanted to ask, and I know John will probably chime in here, is do I need any experience to do this?
Well, there's a seasoned staff in place. So the animators have been with the company. They're contract animators, and they've been with the company for over 10 years. So the actual creative aspect of the business is really well established and in place. There are extensive industry contacts that the seller is interested in staying, on board and helping the buyer to capitalize on. So no experience is necessary because of the team that's in place.
Okay. Yeah, and the funny thing is that if I remember correctly, I mean there is a lot of recurring revenue in this business, right?
That's correct. So the company's about 75% of the existing revenue is monthly recurring revenue, and the existing clients, there's a menu of services that is essentially a subscription. So a company you can upsell within an existing client as well as to expand the client, but it's a very sticky client relationship. I think the very first client is still on board, so it is quite sticky.
Yeah, and like I was just saying, as far as working yourself out of a job, that one of the second things that certainly amplify value is recurring monthly revenue, and being able to forecast what's forthcoming is a real big deal from a valuation standpoint. So I meant to ask you, I mean, what's prompting the sale on this one?
So the owner's family has other business interests, and those opportunities are something they want to focus on. So they're selling essentially to work a little bit more closely with the other family enterprises.
Okay, and I'm certain that one of the other questions will be, I'm assuming there's a non-compete, and they don't have another company that is going, that has any kind of interrelated transfers between this entity and their family other businesses, do they?
No, the other family business is in an unrelated business.
Okay.
Unrelated industry.
Perfect. Okay. Well, thank you for sharing.
Thank you.
David Gorman. So let's talk about this, the office design and furniture dealership.
Yeah. So both of the companies that I wanted to highlight today are, I think, for the right potential buyer, they could be a nice roll up together. Both companies do similar things with similar clients. One company might feature a little bit more into one aspect of what they do versus the other, but I think similar, they're doing the same thing. So this company right here, they specialize in office furniture for their clients. 50% of their business comes from actual office furniture. So if you can think about a client that is maybe establishing a new office, and they've got all of the offices that need built out. They've got cubicles, reception area, conference room, cafeteria. They're going to come in and retrofit everything out. So the process that this company goes through is really what sets them apart from their competition. The process that they really sit down and really understand the needs of their clients. In fact, when they go in for the first initial conversation with the client, they don't even bring in any samples or any brochures or catalogs or anything. It's really to understand that client's needs. And then based upon what they hear, then they establish a complete program for them.
I got it. So why are they selling?
So my client, he has other business interests that he wants to explore. He's a very religious man. So part of what he wants to do is some items with his church and so forth, but none of which is going to contradict what this does.
I got it. So one of the things that, and if you want me to go to the next one before I ask questions, I'm happy to do so.
No, a couple more things that I want to highlight on this company is that literally in 2017 to 18, they doubled the size of their business. They went from $500,000 to 1.2 million in sales. From 2018 to 2019, they did the same thing again. They went from 1.2 million to almost 3 million in sales. A lot of things have come into play for that growth, but it's the growth has continued this year. They're on track to do 2.5 to 3 million this year. So COVID has not affected this company at all.
Well, I'll tell you, one of the interesting things, and I've been following along from an industry standpoint, you know, with the retooling of post-COVID offices. I mean, this may be a real good time to be thinking about getting into this type of business, don't you think?
I do, and I'm glad you brought that up, because the conversation I had with my client this morning was he is seeing, for some reason, he's got right now bids for 13 new startup businesses. Yeah. And so he literally is going to go in and set these guys up with complete offices. So I'll give you another example of his client. So he's doing a union shop downtown Indianapolis right now. It's a $500,000 project, but literally he's all of those things I said, from the conference room reception area to all of the office, all of the cubicles, the cafeteria. He's going to put in seating. He's going to put in tables. He's going to put in anything that you can think of.
So how, and I'm blindsiding you here, and if you don't know, that's no big deal. But what's that?
I was afraid of this.
No. So I mean, do they have a handful of customers, or do they run through hundreds of customers a year? I mean, you know what I mean? Is this big project work, or are they layups?
You know, it's all of the above. So he deals with clients that are pretty much 50 employees up to 500. So he's doing it all in between, and they could be a small job up to this union shop that's a $500,000 that he's getting ready to complete.
I got it. Okay. Let me go to this next one here. Okay, this technical solutions company.
Yeah, so this is again, this is somewhat of a similar company. You know, while they do, you know, the ergonomic furniture and so forth like the previous company, that's not their main focus. Their main focus is what he describes as these data centers. So if you think of a large corporation that has all of their data off-site or maybe in a separate building, but he is going into the data centers and he's providing all of the server enclosures. He's providing the raised flooring. I'm learning all about this, but obviously the flooring can't be on the bottom because of moisture and so forth. So all of the power supplies. So 50% of his business comes from these data center retrofits, if you will. And then 35% of the business is the furniture aspect. So again, I think both these companies can come into play a little bit. They might be a good roll up. Sales are about 1.4 million last year. And I think you've got some of the numbers. Oh yeah, right there. 1.4 million, cash flow is 187,000.
Yeah, and it looks priced extremely well.
Yeah, we went through an aggressive pricing restructure here. We've had this business on the books for a period of time. Client is ready for retirement. He's ready for that next chapter in his life, and so we've reduced the pricing dramatically to come in with this aggressive pricing. Yeah.
So, I mean, from a transition standpoint, I mean, two things. Like I was asking earlier, you know, what kind of experience do you need? Because I know John's getting ready here in about 10, 15 minutes to tell me about how much experience my buyer needs. How much does the experience, you know, can we transition? How much experience of the owner can we transition over to the new buyer? And what does transition look like post sale?
Yeah, so with both of these companies, both sellers have said that, hey, look, we're willing to stay on for a period of time. And if that's lengthy for the right opportunity, they'd be willing to do that. Listen, this isn't rocket science. I mean, they're selling office furniture, right? It's a little bit more complicated with the data centers, but both, I think, can be easily learned, both businesses. And because the owners are willing to hold hands for a period of time, I think the transition should go pretty smoothly.
Yeah, I think a lot of buyers sometimes get queasy about, you know, the relationship that the sellers have with their clientele and how am I going to get that from point A to point B, and by remaining for a period of time, that certainly mitigates that risk.
Sure.
Okay. Anything else on this company?
COVID has really not affected this company either. You know, their year to date is tracking along for 2019. So I think both of these companies are not, at least to this point, are not being affected by this pandemic, and they're remaining strong with last year's numbers.
Great. Okay. Well, thank you. Let me see what's next. Oh, so Lynn Fulkerson, he was unable to join at the last second, so I'm going to go ahead and ride shotgun for him. So he's got this painting company here in central Indiana, and it's a retirement situation where these guys, it's a painting company. Then there's some reservation on some of the buyers that we've worked with on that experience component. These guys it's a good, clean business that has, again, operated for over 60 years. They do various interior repairs that folks like me try to do ourselves and then have to call people like them. So that's somewhat challenging, but they have truly a great reputation, and they are willing to stay for a period of time. I mean, they certainly do not want to close the business and see 60 years of their work go away. And I mean, they're aggressively priced too, and this is, like I said, clean books. So I think this is a good opportunity, and there's a lot of opportunity and what we're seeing with COVID is a lot of people are doing home improvement projects, and these guys are certainly busy and seeing a lot of that, and I expect that they'll continue to see it. Okay, this one, the Wholesale Distributor of food service, janitorial, and convenience products. This is this one has roughly about 15 million in revenue. It's a family that's looking for an exit, and after evaluating the various transfer methods, what was going to be best, that's third party sale, and that's why they engaged us to help find a the next generation of ownership. So, like I said, this thing's been going for 50 years. It's here in Indiana. They service a slew of companies, various, like I said, industrial businesses, convenience stores, schools, and government agencies. I mean, it's a fairly diversified customer base, which will facilitate not having all the risk in one particular industry. Again, they're doing about 15 million real estate, which John will talk about here in a minute, is available. So can serve as some additional collateral for those guys. Certainly motivated sellers. They're doing great this year, and it's a good business. And we from our operation, we're really fortunate that we've been, the companies that we represent, most of them have weathered COVID pretty well, and this is another example of it. All right, let me see, John, it's your turn. Take it away. This is, let me introduce you. This is John Randall. John Randall and I and the firm have been doing deals for 20 years. He's one of those guys here in the community that if he says he can get a deal done, you can all but assume that it's going to. To my knowledge, very few times have we ever had to tell our buyer that, sorry, it's just not going to work. John's quick with the no's or quick with the solution to get to a yes. So John, that's the best introduction I can give of you. So if you don't mind, take it from there.
That was heartfelt. Thank you. I don't know that I have much to follow up on after that, but no, it's great to be here. Thanks for the invitation. Yeah, I've done this 19 years now. I feel like I've got the greatest job in the world. I love helping people make some of the biggest financial decisions of their lives and seeing the success afterwards. And I really like working with folks like you and your team, Ed. You just do a great job pulling together experienced team members to help buyers and sellers across the finish line. And help them thrive post-closing. So thanks again for the opportunity. I thought I'd share just a little tiny bit about Live Oak Bank and a little bit about lending in this COVID environment. And then I'd share kind of a back of the napkin deal structure so you guys can just know what to expect when you're first starting to review a transaction, and then talk about the process and how to get across the finish line quickly. Feel free to interrupt with questions at any time. That's what we're here for. And the easiest way to do that is probably to plug them into the chat box. But Live Oak's been the #1 SBA lender for 2018, 2019, and year to date. And we were recently also named the #1 USDA lender nationally. We lend in all 50 states, and we've got a branchless model. So you'll never see a Live Oak brick and mortar bank. And that's because we specialize in just structuring business acquisitions, helping negotiate the letter of intent, the purchase price, any seller note structure or holdback or escrow, and then getting that funded quickly. So we just don't need branches to do it. It's a fantastic way to get transactions done in a quick and efficient manner. Everybody asks me the first question when we get on the phone, what's it like lending in the COVID environment? And so I thought I'd share a few things that have changed and then several that haven't. First and foremost, as an SBA lender, we're a cash flow based lender. So we've always been focused on the revenue stream of the business and that seller discretionary earnings number, and we'll continue to be focused on it. But we are open for business, and as long as we can make the case that that SDE line will get back to about where it was prior to COVID, you're in good shape. You don't have to worry about a lender slowing down or backing out of a transaction. The way we document that is by getting really up-to-date financials at this point. So if you go back a year ago, a lender was okay with seller P&Ls and balance sheets that were 90 or 120 days old. At this point, we probably want something that's 30 days old or less. And it's okay if the second quarter of 2020 looked awful. We're okay moving forward as long as we can get a month of seller financials showing that they're substantially back on track with last year. So if you can show me that June of 2020 is substantially the same as June of 2019, we're probably in good shape to proceed. And for buyers, what that means is there's a lot of sellers that feel beat up and maybe they're ready to exit, and you get to take advantage of that. And we can show that you're going to be okay going forward with really detailed, very up-to-date financial statements. Really, that's all that's changed. You know, we're still doing low or no cash injection loans for existing business owners that are buying within their industry or a related industry. In other words, you can grow through acquisition with no cash down payment. We're still doing combination loans over $5 million if you're buying a larger business. So you'll get a $5 million SBA 7A loan and then a conventional loan for the remainder, so you don't have to go and shop with a mezz debt lender or bring in lots of extra equity. We're still funding business acquisitions with large collateral shortfalls. Unlike a lot of lenders that have decided to wait on the sidelines until they can establish the health of their loan portfolio, we're doing transactions regardless of the collateral shortfall size. And we're still doing really fast approvals because that's in our DNA and that's how we got to the #1 spot. So with that all being said, Ed, would you be willing to share the slide with the back of the napkin project breakdown?
I am. I was going to ask you. You know, some of these companies have longer sales cycles. So you were talking about, you know, June substantially back. You know, what happens if it's not? I mean, you know, is there a workaround, or does the bank evaluate, you know that our sales cycles, you know, 90 to 120 days versus, you know, here in June, you know what I mean? That the quarter was rough on us, but we're not going to know if we're back until August, September.
Yeah, so there's a handful of things we can do to get a transaction done sooner. And we'll talk a little bit about that in the kind of seller note section or escrow section, because we've got some tools that a lot of lenders aren't willing to use to bridge that gap. We can also look at signed contracts for business going forward. In other words,
Yep.
the business's backlog, and show that the backlog's recovered to document that they're going to be back on track for the second half of the year. And the other thing we can do is structure some things with clawbacks, or not earn outs, but earn ins, to bridge the gap between what the financials show the business can debt service and what the buyer and seller think it may recover to late this year or early next year. And it's all ways to diversify risk to make sure that everybody comes out where they should based on where revenue ends up in the 12 months after closing. So good question. Thanks, Ed.
Well, you're welcome. I lots of people are asking that, from especially a lot of the, when we're starting the sale preparation process, we're trying to, number one, evaluate from a valuation standpoint, what is the likely hit, if it, at all, that they're going to take. And that's going to be queued up as a question, because I know part of your process is that you have to vet it out with a third party valuation. So, we're trying to figure, all right, when we want to advise our clients that what they should expect when we go to market, and when we have an offer, and when we start into financing. And that's why a lot of times, we get this pre-qualified, because we don't want any surprises. We want to know what the buyer needs to look like, and we want to know what our deals need to look like in order to get it across the finish line. And if there is that kind of lag, all right, then let's plan for it today, so we're ready when we have that offer. Okay, you wanted the back of the napkin. Here, you got it.
So what I attempted to do here for discussion purposes is give a sample deal structure that is a good starting point for most buyers when they're first looking at an offering memorandum. And we'll talk about all the variables within it, because, like most things in life, everything's negotiable. But if you start at this point, you'll have a pretty good idea of what your down payment's going to be and what your monthly payment's going to be. So in this scenario, I assumed $1 million purchase price for a business, laid out all of the closing costs, the working capital amount, the down payment, the monthly payment, the interest rate that you could reasonably expect if you were trying to figure out if you wanted to continue to spend time analyzing a business. And in this particular business, I assumed that maybe there was something that was really special about the seller. They had some really key relationships with key customers, or they had a really good relationship with a key supplier, or for some other reason you wanted them vested in your long-term success after the transition. And that's not always the case. I don't require a seller note, but for this example, I assumed that the buyer was going to want to keep the seller really vested in the success going forward, and I included a 10% seller note. So 10% buyer cash injection, 10% seller note, and it leads to a $900,000 loan. I think if you make this assumption, you will be directionally correct on where you end up with your final financing structure. And really the process is to get a really good lender. And one of the things I love about working with Indiana Business Advisors is they can look at any given industry and recommend the right lender for that industry. So sometimes it might be me, sometimes it might be somebody else, but they will get you to the right place based on what you're looking to finance. But if you can get that lender 3 years of seller tax returns and the offering memorandum and a buyer personal financial statement and a buyer resume, it should only take them about 24 hours to come back with a pre-qualification letter and deal structure specific to your situation. And what I would ask you to do is point out to that lender any specific concerns you have about the transition. Are you concerned about a key manager staying in place? Are you concerned about an account receivable concentration? Are you concerned about a key salesperson and them sticking around? And just raise your hand and tell the lender, because a good lender will quickly structure a seller note or an escrow or something to mitigate that transition risk and make sure that everybody wins post-closing. Make sure that the seller gets their money in a timely manner. Make sure that the buyer gets the revenue stream and the profits that they were expecting. And selfishly, as the lender, make sure that the lender gets paid over a period of time. I think you'll learn really quickly if you're working with an experienced business acquisition lender when they start making those suggestions or if they don't. And the goal shouldn't be to keep the seller on the hook for an especially long time. It should be to keep them vested in the transition success, to make sure as the buyer you get what you wanted going forward.
Yeah, and you know what, I'm glad you brought that up for a couple of reasons. One, it's very rare that a lender is interested in mitigating the risk of the buyer and having enough experience to identify unseen risks that you can offer solutions to. That's a big deal. But one of the things that I did want to mention is your claim to fame on, at least in our shop, the speed of turnaround. From the time we give you what you need to evaluate. I mean, it is fast. And so I guess I that's one of the questions someone's going to have is, how fast does this process work?
Really good question. So over the last 15 years, I have an application to close average timeline of 42 days. If I back that up and break it down a little bit, when I get the buyer and seller tax returns and a buyer PFS and resume, in almost all circumstances, I can deliver a financing proposal letter within 24 hours. And you should have some confidence with that proposal letter because I've got a 97.8% approval rate when I issue those. Please don't try to conceal your felony or your bankruptcy or your pending litigation. We will find it, but it throws off my 100% approval rate. So those are really the only things that get in the way at that point. But what that means is if you can get the offering memorandum and tax returns and a fairly straightforward personal financial statement that just takes a few minutes to fill out, you should know within about 24 hours what the deal structure is. And then you can negotiate your letter of intent, and it shouldn't take long because you can pretty much follow the sources and uses chart in the pre-qual letter as you write your letter of intent. At that point, it's 7 to 10 days to a loan approval, which is really anticlimactic because it'll look just like the proposal. And then you go through the business valuation and due diligence and documenting the purchase agreement phase. And all in, it would normally be 40 to 45 days. Most folks on this call are probably aware that for SBA loans that close before September 25th of this year, there's 6 months of payments made on the buyer's behalf. In other words, you get 6 months free. Sounds like I'm selling furniture, not SBA loans. But
buy here, pay here.
But for things that close before September 25th, there's 6 months of free payments. What I want you to hear is that closings might take a little bit longer than 42 days for projects that are starting right now, because there's going to be more SBA loans closed in August and September of this year than most 4 or 5 or 6 month periods in recent history. But that's okay. The good SBA lenders that it's all we do are still getting approvals done quick. From a practical perspective, I would say that if you want to go into a purchase and have certainty that you're going to hit that 6 month free payment, you probably need to have your letter of intent signed by today or tomorrow and your application in over the weekend. But there's also another bill working its way through the Senate.
I was getting ready to mention that.
6 months free goes away, you're probably going to see some similar benefits, if not an extension of those benefits. So don't do a deal to get 6 months free. Do a deal because it makes sense, and know that that benefit's huge. And even if you don't get it, you'll probably get something similar.
Yeah, and I'm tracking the same thing, that you know, there's an awful lot of opportunity that, you know, just to push that kind of throughput on deals on folks like you that's a big ask to push those deals. And so yeah, I'm following the same thing that we're looking at. Hopefully they'll continue to extend this. And that's what we've been telling, you know, business buyers and sellers, that, you know what, there is absolutely no better time in our 40-year history to be looking at buying or selling. You know, multiples are still going good, and you know, certainly the availability to capital is great. I have a question. Give me 1 second. Am I recording? And will we make it available? Yeah. Yeah, no problem. We will, this presentation is being recorded, and it will be sent out immediately following, well, not totally immediately, but within the next few hours, we'll be sending out the recording, the slides, as well as the available for acquisition newsletter that we have. All right, John, anything else on this slide?
No, I think we're good there. Have there been any questions that rolled in about closings or escrow or anything?
Well, you want to talk about this slide, or did you already touch on it without me?
Yeah, I can touch on this. So there's an SBA rule that says the purchase price of a business has to be fixed at the time of closing.
Right.
In other words, you can't have an earnout in an SBA financed loan. And the SBA does that because they don't want to think they're financing $1 million project and find out there was really $1.5 million paid to the seller over a period of time. It theoretically makes that loan more difficult to collect. However, there's no prohibition against doing a seller note as part of a $1.5 million purchase that, if certain metrics aren't hit, shrinks from 500,000 down to 0 or anywhere in between. And so in this COVID environment, where maybe revenue used to be $3 million and now it's on track to be 2.5, but everybody really thinks it'll recover next year, one of the tools I'm using is a seller note with a clawback, or an earn-in, or a shrinking seller note. And we can tie that to revenue in the months following closing. We can tie that to the retention of a key customer or a key employee. We can tie it to an EBITDA level. There's no prohibitions on what we do there, but it is fairly unique. A lot of lenders won't go there. We can also structure a seller note with no payments during the life of the SBA loan and use that for up to half the buyer's 10% down payment. So you could potentially get in for as little as 5% down. And we can also hold back seller proceeds for a period of time, let's say 6 or 12 months, until certain things happen. And at that point, release those funds to the seller. So there's a lot of tools in the toolbox to mitigate risk and make sure that everybody gets what they want at the closing table.
Yeah, and you're, as far as the reverse earnout, the term, if I'm not mistaken, is self-canceling note. Isn't that the technical
Correct.
term?
Yep.
Okay, so yeah, if you're Googling what we're talking about, it's called a self-canceling note. And again, that's a vehicle that accomplishes the same thing as an earnout, which is basically if then financing. If something happens, then I'm willing to pay you. If it doesn't, I'm not. And so that it's an excellent vehicle. We've been deploying that type of financing for years, especially in service businesses where there is a lot of value tied to the owner, and that transition is important, especially when we're dealing like insurance companies, accounting practices, things like that. Okay, John, I have a couple more questions. Does the size of the loan impact the time to a close?
I would say that one's almost counterintuitive. Theoretically, it shouldn't. There's the same amount of documentation required in a $500,000 loan as there is in a $5 million loan. What I would say is, as we rush towards the September 25th deadline, larger loans are probably going to close slightly faster than much smaller loans. So if you've got a transaction under $500,000, make sure you're working with a lender that will look at you in the eye and commit to getting it done. Because the reality is, when they hand that to their underwriter or their closer or their legal counsel, there's going to be larger transactions that are yelling loud to get across the finish line first. So make sure you're dealing with somebody you know and you trust.
Okay. All right. Here's the questions that came in through email. So first one, what's the minimum equity a buyer has to bring for an SBA loan? I think you've already said that. That's what, 5%?
So 10% equity is the SBA rule. Up to half of that can be in the form of a very well negotiated seller note. And we haven't mentioned it yet, but there's some really great programs to access retirement accounts with no tax impact and no early withdrawal impact. So work with the folks at IBA or work with a good lender, and they'll show you some ways to access equity that you may not have thought of.
Okay. So can I combine a leverage buyout and the SBA to complete a purchase? I'm not certain I understand that question. Maybe you do.
I would argue that almost all SBA financed business acquisitions would qualify as leveraged buyouts.
Yeah. Okay.
The reality is, if you're putting in 5 or 10% equity and getting 90 or 95% leverage, I don't know the background from where the question came from, but I would argue they're all leveraged buyouts.
Right. Okay. I think you already said that you need to put the pedal to the metal in order to get in line for the 6 months, financing. Okay. Question out of the chat box: if two businesses are synergistic, can one loan be processed for both?
So in theory, yes. What I would tell you is that the logistics of getting two purchase agreements with two different sellers, with probably 3 different attorneys and multiple business valuations and multiple lines of insurance, all lined up to do 2 different closings on the same day, seems like a lot more work than you need to. I would recommend doing 2 separate loans approved at the same time by the same lender. And that way, if one needs to close a week before the other because of somebody's vacation or last minute item, you're not scrambling or kicking yourself.
Okay. Let me see. I think I'm at the end of my questions. I'm going to give a last call for any additional questions. Just put those in the chat box.
I'll throw out one thing that's come up regularly. Lots of PPP loans are outstanding for the sellers of businesses. There's also some EIDL loans outstanding. And much like other debt outstanding against a business, the SBA's take is that those should be paid off at or before closing. If I'm a seller, I don't really want to pay off a loan that I think is going to be forgiven. So Live Oak Bank's approach to this, and we believe this is fully within the spirit of the PPP program, is to withhold the PPP loan amount from seller proceeds at closing and put it in an escrow account. That gives the seller the opportunity to go through the forgiveness process. And if and when those funds are forgiven, we will release funds from the escrow account and give them to the seller. If, on the other hand, they're not fully forgiven, we'll take those funds and pay off the remaining balance and then give the difference to the seller. But that allows a buyer to close in a timely manner. It allows seller to get their funds in a timely manner and to take advantage of the forgiveness program.
Okay. One of the things that I wanted to ask you is, what's your crystal ball say? You know, I know, you know, we today we came out, the federal government came out with a dismal shrinkage of the economy, which I'm trying to understand why that's a surprise to anybody. But nevertheless, I think we're on the rebound. But as it relates to this, you know, what does the remainder of 2020 look like for you as far as the appetite for acquisitions? You know, you think it's going to get extended? And I'm not holding you to this. I'm just trying to, you know, I think it's on everybody's mind. You know, should I wait, or is it going to get better, or what should I do?
I think that's a good question. Obviously, this is my opinion. I have no way to know for sure. But what I will tell you is that the House stimulus bill, the $3 trillion package, included an increase in the 7A loan program from 5 million to 10 million. It included a guarantee fee waiver, which is roughly 3% of 75% of your loan amount.
Oh.
And that doesn't correlate on a dollar for dollar basis to 6 months of free payments, but it's pretty close.
Yeah.
Many in the Senate have expressed support for those enhancements to the SBA program. The SBA program is unique in that it's used to help the economy recover. So when you get dismal news like we saw about the second quarter economy today, news like that generally helps our legislators improve the SBA program for a period of time.
Yeah, that's a good
point. So while those numbers that came out today are on an annualized basis, so the impact is enhanced, you know, it was really only a quarter of that reduction that was reported, and then they annualized it to get to the headline. I think that headlines like that probably help both sides of the aisle pass some things that enhance these programs and will drive business acquisition financing really well through the end of the year.
So my last question has to do with valuation, and you know, as part of your program, I mean, that you need a third-party valuation during this time. How are your appraisers, or what are the valuations coming back? And has it been a surprise, or what's the workaround, or are they making assumptions that enable you to get the deal done? I mean, what are they doing? Because I mean, we're talking, you know, present value of future benefit, and when you can't see as far out as you normally need to as an appraiser, that causes me to cringe. So what's the workaround?
So I have not submitted deals where I have not been able to show a recovery in the most recent month. Whether it was, you know, the last 2 weeks of May and the first 2 weeks of June, or now I'm starting to see the first 3 weeks of July to show that things have recovered. And in those scenarios, the business valuation showed the future expectations based on the business recovering, and we were fine. The reality is, if I'm concerned about it on the front end, I'm going to structure a seller note for the portion that concerns me. And even if the valuation comes in lower, it should still cover the SBA portion of the financing. So that valuation's not holding up the closing of the deal. And if that revenue doesn't materialize, the seller note doesn't get paid because it had the self-reducing note language.
Yeah, that makes sense. And for the sellers that are on this webinar, I mean, that there's no reason why not to go to the market. You know, a lot of people are worried about, you know, what is the value impact? Well, you know, once you have a buyer that has made an offer on your business, and you know, we're in that value range, you know, regardless of the current year to dates, those things can be explained away. I've been saying this for, since COVID started, that this is hopefully it's a non-recurring event. And, we can work around non-recurring events. If this is ongoing, then it becomes problematic. And that's when, there's vehicles to kick in, like you were saying, the self-canceling note. All right, let me run through the email. I don't see anything there. Let me check over here in the chat. Last call. All right, I don't think, unless something comes in the next couple minutes, I'll go ahead and kind of wind this down. So, John, as always, bud, I really appreciate you coming on and talking about, the good that you do for the people we serve, and we're so grateful for your sponsorship, as well as the friendship and counseling many of us through these transactions. So thanks for being here. I also want to thank my colleagues for joining us. It's you guys are great deal makers, and we're so grateful that you're part of the team and helping people get into business and helping the sellers that we serve. And finally, for you that oh man, one second, got a new question. So what was the minimum on equity? John, you want to talk about that one more time?
So for back to the napkin purposes, plan on 10% equity.
Okay. We'll
get into the details and figure it out from there.
All right, Dustin, you got it right in under the wire. So as takeaways, we're going to be sending out the slide deck, the recording, and a link to our existing, our newsletter that has all of our companies that are available for acquisition. We always encourage you to, interact with us either on the socials, either on LinkedIn, Facebook, Twitter for some of us. We have a podcast called Defenders of Business Value that I run each week. You're welcome to, we certainly encourage you to listen there, where we talk about all things that have to do with value and doing deals. So on behalf of Indiana Business Advisors, we're so grateful that you took this time today, and we hope that you found some value. And if we can ever come alongside of you to help you get into business or help you get out of business, we're happy to do that. So thanks so much, and we'll see you soon. Thanks so much.